Hello and welcome to lesson 6 of the day trading course, and today we're going to talk about the flow. On the previous lesson we talked about the central bank dealers range and we talked about the time window for the central bank dealers range, which is between 2 p.m. Eastern Standard Time, which is where we have true day close, to 8 p.m., which is the time that actually starts Asian session. Now that is what we typically class traditionally in retail. We class that as the dead zone for Forex, because there's not really any active time window or active trading session around that time window. So the market usually tends to go into a very small little range, and price tends to not see a lot of displacement or delivering price. Now that is typically what we utilize for our central bank dealers range, and that usually is where the algo will draw the references for the next day's highs and lows in terms of price delivery, and that usually will align with a PD array of some sort. It could be a sell-side liquidity pool, buy-side liquidity pool, or some kind of premium or discount. Now with the flow, you're gonna notice that sometimes that consolidation between 2 p.m. to 8 p.m. Eastern, sometimes that bleeds into Asian session. So you can get a situation whereby the range that starts during that dead zone or dead period from 2 p.m. to 8 p.m. Eastern continues into Asian session. And when we have that one smooth range from the central bank dealers range that then goes and continues into Asian session, we call that the flout. So I'm going to type this out so you understand what I'm saying. And this is what we call this. It's called the flout. Okay, and the flout essentially is the range from the central bank dealers range added on to the range from the Asian range. Now, when do you want to use the flout over utilizing the central bank dealers range? You don't go in and look for every Asian session plus central bank dealers range to go and utilize the flout. You're looking for the central bank dealers range to have almost or identical ranges or price ranges as Asian session, and then you can use that as the flout. Now you can see here, this is the most recent price action with USCHF, and you can see we had a bullish day where the market expanded higher, or the market closed higher than it opened, so that is actually bullish in price. Now this is our central bank dealers range here. This is where it starts, and this is where it ends. And then this is our Asian range here. It starts here and ends here. Okay, again, going back to that JPEG file I dropped in terms of the time zone, you can see the central bank dealers range. The time period for that is 2 p.m. to 8 p.m. Eastern. And for the Asian range, it is 8 p.m. to midnight New York open. So we have the central bank dealers range here, and we have the Asian range here. Now you can see on the central bank dealers range, we don't like to see price action like this. We don't like to see the market see any kind of displacement, significant displacement. We want to see sideways price movement. So with the central bank dealers range, which is this one here, there is a lack of consolidation. There's a lack of sideways in price. Okay, and then going over into the Asian range, there's also a lack of sideways price movement. So you can see downside displacement on the central bank dealers range, and then higher displacement on the Asian range. This is not ideal for our flout, so we use neither. Now I'm going to come back into this and talk about what you should do in this situation, and I'm going to teach you something even special with this. Okay, but because you can see that lack of smaller range, if we measure the range, actually you can see it is around 25 pips. Now I said ideally you're looking for 20 to 30 pips for your central bank dealers range, but USCHF is a pair that does not trade a lot. Okay, it's a pair in which the ADR, which is the average daily range, usually is around 50 pips. Okay, so it's not a lot in terms of price delivery. So not only looking at the number of pips which is done inside of the central bank dealers range, also the nature of price delivery. You can see there's clearly a displacement in the central bank dealers range. You can see that run lower, which is clearly bearish delivery, and then during the Asian range, there's a higher price delivery. It's not a consolidation. When you don't see consolidation on the central bank dealers range, you don't use anything. Okay, you can also use the Asian range too, but the Asian range is not a consolidation. It's also very obviously trending. The market is going higher and making higher highs and lower lows. So neither the Asian range is good for our standard deviation nor the central bank dealers range. So this is not a good example. So it's very important I told you or I described to you when these concepts are not really valid. When you see obvious displacement in price, that is not something the algo will want to pull or utilize to project the daily high and low for that daily candle. Okay, so now if we go and look at a more better example, let's look at Monday from last week, and let's go into Monday from last week. Now you can see here, this is new week open. The previous week's Friday, this is the start of the central bank dealers range here. And this is the end of the central bank dealers range here. And then for Asia, this is the start of Asian session. And then the end of Asian session stops right here. So you can see that we have one smooth range between central bank dealers range to Asian session. What is the order flow for the central bank dealers range? Is it bullish or is it bearish? Neither. It's neither running higher nor going lower. It is staying sideways. What's the price delivery for Asia? Is it bullish or is it bearish? Neither. It's also neither going higher nor is it going lower. It is staying flat or it is staying sideways. So we have sideways movement for both the central bank dealers range and then the Asian range. So central bank dealers range staying sideways, and then the Asian range is also staying sideways. So we have sideways movement for both of them. When we see this kind of delivery, we can take the range as one. And what you do here is, rather than using only the central bank dealers range to pull up your standard deviations, you go and use both the central bank dealers range and then the Asian range. So what are you doing exactly with the central bank dealers range and the Asian range? Now, first off, remember that a combination of both the central bank dealers range and the Asian range is what we call the flout. So together, this is what we call the flout. The flout is the time period between 2 p.m. Eastern to midnight New York, which is a combination of both the central bank dealers range and the Asian range. Now, we only use this when the range between the central bank dealers range and the Asian range can be blended into one, because they're both a small little tight consolidation. This is where we get the flout. Now, how do you want to utilize the the standard deviations with the flout? It is quite different from just the central bank dealers range. Now, as usual, how you want to start off is you want to identify the highest close inside of the range. So we have one here, we have another one here, and then we have one here. The highest candle that closes is this one here. And then the lowest close, that's this one here. So we're gonna pull from the highest candles, or the highest body close, and then the lowest is this one down here. And so we pull up our Fibonacci to identify standard deviation. Now, this is quite different from the central bank dealers range. Now, with the central bank dealers range, all you need to do is just pull up your Fibonacci, and then you can go and look at the extension levels for your standard deviation. Okay, so let me just do this here. I'm going to remove the 618 extension level, 786, 1618. Okay, so our only concern is with the standard deviation. Okay, so we only want to see standard deviation on our chart. I'm going to get rid of this. So this is only standard deviations here. Now, classically with our central bank dealers range standard deviations, once we pull up our Fibonacci, we're looking for range extensions for our standard deviations. But with our flout, we're not just going to utilize the highest body close and the lowest body close for our standard deviation. So once you identify your highest body close and then your lowest body close, you divide the range into half. Okay, this is a really important part. You divide the range by half and you get this. And then you pull from the equilibrium of the range to the highest body close for standard deviations higher or positive standard deviations, or you can pull from the equilibrium of the range to the lowest body close for your negative standard deviations or the lower portion of the range. Okay, so now if we are projecting, because we're looking for bullishness here, right, we're expecting, again, Monday usually we see a run against order flow, so we're expecting some kind of run into a premium of some sorts. So if we're anticipating bullishness in price, and we're looking to see where the market most likely is going to cap up the high of the day, we pull from the middle point of our range to the highest body close of our range. And let me add more extension levels. We have one standard deviation here, okay, to standard deviation here. Remember, from here to here, even though I say it's 2, this is actually 1, all right? Even though I say it's 2, this 2 stands for 1 full standard deviation of the range, unlike the negative standard deviation where -1 stands for a full standard deviation. With the positive standard deviation, 1 is actually 2 on the Fibonacci level, because if you try to change the number to 1, it will just take you back to the high of the range. Okay, so 1 standard deviation is here, 2 standard deviation is this, 3 standard deviation is this, and 4 standard deviation is here for bullishness. So we're going to put our line to 4 standard deviation, and you can see that the high of the day literally forms at 4 standard deviation of our flow. Now, if you remember one of my comments from the previous lesson, I mentioned on a classic trending day where the market is obviously trending and seeing higher highs and higher lows, or lower highs and lower lows, you're going to get 4 to 5 standard deviations to cap off your daily range on average. And you can see here, you actually have 4 standard deviation that caps up the high of the day. Now, where does this form at? London close. So this is London close, open for London close, and the aim for London close here. If you went back to the time window for the daily models, we talked about the time of the day where price is most likely to form the opposing end of the daily range. That typically is London close. Remember, what makes the low of the day majority of the times? London. That's what you see here. London runs lower, below sell stop, and below the borders of this candle, starts at displacement, trades down into a bull shoulder block with a fair value gap, sees displacement, trades back down into a propulsion block, sees expansion, and guess what? Going into London lunch, we start to see the market retrace. Going into New York open, the market starts another Judas swing lower. This is what we call market retraction. We talked about this, where majority of the times New York will see a continuation from London. Where does New York trade down into? The breaker block. The last 3 candles higher, price to run lower and sell stop. That's where New York session trades down into. You see a breaking structure higher, market trades back down into an old fair value gap, which is actually a balanced price range here. Market displaces above this, consolidates at the propulsion block, expands for buy side liquidity, and then caps up the daily range at London close. And then going to end of day, consolidates. This is classic intraday bullish template. Matter of fact, this is something I want to screenshot. We're gonna, when we're talking about the intraday template or profile, I'm actually going to use this example for this because this is a perfect description of what is most likely to occur majority of the times on across all your currency assets for an intraday bullish profile. Okay, for an intraday bullish profile, that usually is what is very likely to occur. You can see the next day here, the low of the day forms your London session. We have an aggressive run lower that clears out sell stops, clears out the rejection block here. Low of the day during London session starts here. So let me just show you where London session actually starts and ends. So you can see the profile is actually repetitive. Start of London session, end of London session. In between this is your London launch. Dead period, consolidation, you can see how the market consolidates. Start of New York session, end of New York session. London close, end of London close. Low of the day forms your London session. Price starts delivery, go into London launch, consolidation like I taught you. Go into New York session, you have your again market retraction, which is the false move, same as London session. Retraces back into some kind of range from London, okay? This old fair value gap here. That's what it actually was retracing now into, plus this bullshit block here. Continues to deliver profile from London heading into London close and then caps off the daily range for a bullish profile or a bullish template. Now the better question here is, let me get rid of all of this, okay? In this example, this is the start of our central bank dealers range here. And this is the end of our central bank dealers range here. And then this is the start of Asian session and end of Asian session. In this example, are you going to use the central bank dealers range or are you going to use the flout, which is the blending of both the central bank dealers range and the Asian range? Which are you going to use? Are you going to use the central bank dealers range or the flout? What do you think? So I know actually I cannot see your responses because this is a recording and you're watching a recording of me. All right, but again, I want you to give yourself a moment to think. Okay, in this example, are we using the flout or the central bank dealers range? If you said the flout, then your answer is not correct. Okay. The reason why is because you can see that Asia sees displacement out of the range from central bank dealers range. Now, what we'd like to see typically is we'd like to see Asia remain relatively inside the range from our central bank dealers range. So if you take your candle or your range projection from the lowest candlestick body and the highest close here, around 30 standard deviations is where we cap off the, it's more like 30.5. Okay, so 30.5 can go in your Fibonacci and we can add this. Again, 30.5 simply is the half range measurement, or sorry, I should have modified this. Okay, so it's more, and this is where the market caps off the daily range, and 30.5 simply is 3.5 standard deviations of your central bank dealers range. And yes, I know you have questions about the 3.5. You can use half standard deviation of the range. Okay, so for your standard deviation, the only models are valid is 1.5 standard deviation. So you can also use 1.5 standard deviations or 2.5 standard deviations or 3.5 standard deviations, okay, or 3 or 4. Just like just like you use your round figure numbers and also your mixed figure numbers, that's the same thing you can also use for your standard deviations. Okay, they still apply to your standard deviations. So for this, I prefer more of the central bank dealers range. It's more of a preference. I prefer more of the central bank dealers range because I don't see Asia consolidating inside of the range formed during the dead zone or the central bank dealers range, which is why I'm opting to use the central bank dealers range in this example. Now, another question, and I said I'll come back to, which is what we started out the video with, was what happens when you see a day like this where the market does not create an ideal range for our standard deviation. So this is a daily divider here. This is our dead zone or our central bank daily range here. That's the start of it, and then this is end over here. And then start of Asian session, obviously, and end of Asian session is right here. And so we have downside displacement or delivery for Asia, and then higher displacement or delivery for, downside displacement or delivery for central bank daily range, and upside displacement or delivery for Asia. So this is not a range where we can pull a standard deviation, because it's not a sideways price movement for the algo to go and then draw range projections for the next day's trading. So what do we do in this situation? This is very important. I want you to listen very closely to this. What you want to do in this situation is you go to the previous day's central bank daily range or flout, and then you pull from there. Okay, so because this does not have an ideal range for us to pull and project the highs and low of the daily range, we then go back the previous day and then we pull from there. So if we went back to the 22nd, you can see this is the start of central bank daily range, and then this is the end of our central bank daily range here. So if we took the lowest candlestick body closure here and the highest candle body closure here, and we projected it until the next day, you can see at 7 standard deviations we have our high there. Okay, that is during London session, where the market makes the high of the day and then sells off and trades back lower. Okay, so this is a profile where London makes the opposing end of the daily range, and then the market goes into New York and sees a reversal. This is classically a signature type profile, but usually this will happen if the delivery profile or cycle is a continuation of delivery from the previous day's trade. Okay, so classically when the market makes a short-term low or high and it's going for a level of stop, where's the level of stop? That is the buy-side liquidity here, right? Why is that a level of stop? Because they are relatively equalized or clean eyes up there. That's a liquidity pool right there. So once you start to see the market start to run for there, you already know that it's going to this PD array to run buy-side liquidity. Now, what standard deviation lies around that liquidity pool right there? This. What are you going to opt for? This is actually, this is 7 standard deviations here, and this is 6 standard deviations here. Why are you not going to opt for 6 standard deviations? Why are you going to go for the 7 standard deviation? Because the 7 standard deviation takes us above the liquidity pool. The 6 standard deviation does not take us above the liquidity pool. We know that as the market runs lower, retail are leveraged short. If retail leverage short, where they're going to have protected buy stops above the most recent short-term high, which is this one here. So if we can drive the market up above the side, we can then go and pair liquidity. Okay, so if we go all the way up here and then sell short, it does not make sense, because liquidity, the bulk of the liquidity is resting above the side here. Okay, this is layered liquidity. So we want to see the market go and pair against the bulk of liquidity resting above the side here, and the nearest standard deviation to our liquidity pool up here is the 7 standard deviation. So in situations where you do not see that day form an ideal range for a central bank daily range, you can go back using the previous day's central bank daily range to utilize your range projections. And this is how you can utilize your flout for a range delivery, or the previous day's trading range for to project your highs and lows for the daily candle. Hopefully this was an insightful lesson, and I will see you all on lesson 7. Safe trading.